They told you America wins trade wars. They told you tariffs protect jobs, and that the domestic economy was firing on all cylinders. And for a while, the stock charts agreed with them. But the political rallies left out the most important detail. Every tariff placed on foreign goods was a tax, collected at the border and passed directly to you. Look closely at your household expenses. The line items quietly ticked upward. A new washing machine cost an extra $86. A steel refrigerator jumped by $165. A pickup truck climbed by $3,400. Let's clarify the mechanics, because tribal political noise buried how this actually works. A tariff is a customs duty. When a U.S. retailer orders televisions from a Chinese manufacturer, and they arrive here in the port of Los Angeles, U.S. Customs collects the money from the American importer. The check is written by a company headquartered in Ohio or New Jersey, not Beijing. This animated chart illustrates the pass-through rate of those 2018 border costs. The data shows that foreign exporters absorbed almost nothing. American businesses paid the difference and passed it on at a near 100% rate. Over 2 years, this drained an average of $831 directly from the annual budget of a typical American household. The billions in new revenue flowing into the U.S. Treasury looked like a penalty imposed on a foreign adversary. In practice, it was a quiet, highly efficient wealth transfer out of your paycheck and into the government's accounts. The American economy runs on protected markets, built for the people who can afford lobbyists to write the rules. Trade policy is industrial policy. It is an ongoing competition where organized interest groups capture wealth from the unorganized majority. The administration sold steel tariffs as a lifeline for American jobs. Those protections did save roughly 8,700 positions. Meanwhile, U.S. Steel saw revenue jump, and their CEO collected a $14 million compensation package that same year. Look at this scale visualization to see the resulting kill math. On the left, 8,700 saved steel jobs. On the right, 175,000 downstream manufacturing positions put directly at risk. Every job protected cost 16 jobs elsewhere. Foreign trading partners understood this pressure point perfectly. When the European Union retaliated, they didn't pick random exports. They targeted products engineered to inflict political pain in specific congressional districts, like these barrels of Kentucky bourbon, Wisconsin motorcycles, and Florida orange juice. When American agricultural exports collapsed under the weight of foreign counter-tariffs, the government authorized $28 billion in emergency farm bailouts. Farmers were used as leverage in a negotiation, and then paid with their own tax dollars to offset the damage that the negotiation caused. The civilian cost of living acts as the battlefield, while concentrated groups collect the profits and the protections. You might wonder why a policy with such clear structural costs maintains enthusiastic public support. Behavioral economists call it identity economics. People will routinely make financial decisions that damage their own wallets, as long as those decisions align with their perceived political tribe. The narrative relies entirely on loss aversion. Pointing out that a foreign country is stealing jobs creates a highly visible enemy. It gives the brain a perpetrator to focus on. Meanwhile, the actual cost is broken down into thousands of invisible microtransactions spread across your daily life. While citizens argued about flags and economic nationalism, large multinational corporations petitioned the government for tariff exclusions. Companies with deep pockets and Washington trade lawyers bypassed the taxes completely, while small manufacturers absorbed the full hit. Then there is the delayed blast radius. The initial tariff implementations fractured 3 decades of global supply chains. Companies couldn't rebuild domestic factories overnight, so they absorbed the higher costs, burned through their inventory buffers, and waited. This timeline graph maps the trajectory of those embedded costs. The 2018 tariff policies build pressure underneath the surface. When consumer demand surged in 2021, it collided with already broken supply chains, contributing materially to the massive inflation spike that peaked at 9.1%. The landmine was planted on corporate balance sheets years earlier, but it detonated directly inside middle-class bank accounts. Prioritizing political theater over supply chain reality ultimately engineered a devastating loss of purchasing power. The top 1% of investors did not spend those years arguing about whether the tariffs were good or bad. They ignored the outrage and methodically adjusted their portfolios based on the data. Institutional capital recognized that supply chains had to move out of China. They deployed geographic arbitrage, pouring money into industrial automation and real estate investment trusts across alternative manufacturing hubs, like this cleanroom facility in Vietnam, India, and Mexico. They also monetized the chaos. This chart tracks the violent spikes in the VIX, Wall Street's fear index, driven by unpredictable tariff announcements. Sophisticated traders used these exact moments of panic to sell expensive options contracts to fearful retail investors, turning political volatility into a recurring paycheck. Looking at the exact same dataset, those investors realized the cost of basic goods was destined to rise. They layered in Treasury inflation-protected securities and commodity ETFs, structurally hedging their wealth against the exact price hikes that average households were forced to absorb. This is the definition of policy agnosticism. The wealthiest investors strip emotion and identity out of the equation entirely. Disruption creates mispricing, and mispricing creates an information edge. The entire mechanism of wealth extraction depends on keeping you engaged in the fight. As long as you are busy defending a political identity, you won't audit the supply chain carve-outs, the lobbying exemptions, or the currency arbitrage. So I have to ask you, if American consumers pay the border taxes and American farmers pay the cost of retaliation, is there any mathematical scenario where the average U.S. worker actually wins? Or is winning a trade war just a story told to justify someone else's profit? Let me know your framework in the comments. If this breakdown changed the way you read economic headlines, subscribe to the channel. Every week, we follow the money to reverse engineer the strategies used by the top 1%. The link in the description will dig you a deeper dive into defensive portfolio construction. Stop debating whether it should rain, and stop waiting for politicians to fix the climate. Policy is weather. Build shelter. I'll see you